Hi everyone, this is Anes, and in this video we are going to look at hedge fund trade risk. So in the previous video we saw earnings, then we saw CEO and politician. It's very similar to CEO, to insiders trading and politicians, because it's based on hype as well, you're going to see. So hedge funds, they file their trades every 3 months on a quarterly basis, and they do it in 13F filing. We put it in Python, but you can also review them yourself if you're curious, like search for hedge fund and see what they did. But the idea is that all the funds with more than $100 million in AUM have to disclose what they did. So they have to disclose their holdings, etc. And this you can find it just like for insider trading on Edgar. And it's a hype trade. So just like politician trades, it goes up right away. Usually it jumps overnight because the news is released. And then after the jump, it feels too late to buy. But what really happens is that there is more momentum coming from people who learn about the news, and it keeps going up. Then the hype flattens, and then there is the post-hype dip. Okay, so again, it doesn't happen like this every time, but most of the times it's like that. And so it's just a hype trade. But long term, there is no signal. So long term, forget about it. Okay? Bill Ackman, so you have a lot of hedge funds. Bill Ackman, when he says he bought something, everyone buys. Okay? So we bought Uber 1 week before him. Welcome to the gang. We bought Uber before him, and actually, I bought like options on Uber for earnings, and it happens that the guidance was weak. Okay, so they missed. And the next day, Bill Ackman says, we loaded on Uber and now it's their biggest position in their portfolio. And boom, it went up and my options went up like plus 300% because he bought. And in this case, it kept going up. So like you can look at fundamentals, you have to do the whole analysis. Again, there is something about it, how to predict based on financials, industry prospects and everything. I'm going to cover it. But the idea is that you should treat this as a short-term signal only. In this scenario, the signal did way better than expected. It's all-time high, etc. Everything is great. But again, it doesn't happen like this every time, okay? Especially with Warren Buffett, some value stocks, you don't know what's happening. They drift around. It takes a lot of time for them to pick up. The growth can be faster. Anyways, let's keep on. And so we bought before the spike, so we got lucky. But if you miss, you just time. You time the momentum after, and that's fine. Okay. And again, you keep your allocation under 1% for hype trades. Okay. So if you buy it long term before you're happy, you could have put like 5% in Uber. It's fine. You know, like you hold long term. But if you buy and you know you're going to need the cash soon, or if you buy and it's a lot of money, you can't easily remake it because you don't earn that much. It's a big percentage of your savings. Or if you buy but you have a plan to buy a house or something soon, you cannot just short-term trade it. You have to think you better not buy basically. Okay? So you either buy long-term and you know you hold and you see what happens and it could go down, or you buy short-term and you keep it small. Now, Cathie Wood, she's the hedge fund manager of Ark. It's a big growth fund. It was famous for Tesla peak. Actually, I bought Tesla before the hype. I thought everyone had Make of America, and they all made fun of me. Okay, so like the whole guys on the floor, they knew I was buying it. They made fun of me. Now they are still there. Okay. Anyways, so she bought Tesla. She was famous for that, and she bought and she sold Nvidia. Okay, so like she says, before selling Nvidia and Ark, how do we know that the market was going to reward it? And the other Max 7 stocks, Max 6 stocks to the exclusion of stocks that will be the prime, etc. Anyways, so there is no long-term signal. It's not because Cathie Wood is saying it that she knows better. Okay, so again, Cathie Wood knows nothing. You know nothing. Okay, I know nothing. Okay, and Jon Snow, he doesn't know anything either. Okay, so like nobody knows. This is all very risky. Okay, it works in statistics, But again, statistics doesn't mean you play 10 today. It means you also need to stagger the entries, okay? So like you have to understand how this works. And I'm going to make videos where you visualize it. You don't just come with a portfolio and buy everything in one go, okay? You either come and enter slowly over 1 year because it's a big percentage, or you're going to tell me my portfolio is less than my monthly savings. If your portfolio is $1, okay, buy all in. Who cares? It's $1. But if it's as much as your monthly savings, or worse, if it's a whole annual year of savings, imagine people, they spend a whole year saving this amount and they buy one thing right away, or even 10 things right away. No, you DCA, you enter slowly. So again, follow this here. I'm repeating it on each video because I want to make sure everyone understands, but I will show it for options even better. So thanks for watching, and let's move on to the next risk.